Think about your exit plan from your business. If you own a construction company, you are very likely thinking about how to maximize the return on your investment of blood, sweat, and tears and money as you transition out of your business at some point in the future, whether it's 5 years, 10 years, 15, 20 years from now. The point is, you need to start thinking today about how you are structuring your business for that successful transition and exit. And that's why succession planning, transition planning, exit planning, however you want to name it, is vital. Today, my guests are Noli Snobar and Craig Boyce. They are partners in the accounting firm BFBA. They have deep experience working with construction companies, helping them with these critical issues. And today we discuss the pitfalls and the challenges associated with exit planning and succession planning. We talk about why construction companies fail to do it well, what they need to focus on in order to be successful, and how they might structure that transition to best benefit themselves and the folks who they will be moving the company to. And we are particularly going to focus on a model that they have put together that helps internal candidates, internal second-generation candidates, purchase the business from first-generation owners. And that model is a very interesting one that we go into great detail on. I think you'll find it something for you to think about and to consider. And as you do that, I want you also to think about what you're doing today to prepare your business for that transition. We talk about a variety of different things, including the importance of mentoring, the importance of team building, how you identify internal candidates in terms of filling those key roles in your organization of bidding work, planning work, and building work. We talk about administering an exit and succession plan and how vital it is to get the right people in the right seats in order to do that. And overall, we have a terrific discussion. I know you'll find it very, very helpful. Now, if you're listening to the podcast today, you may want to check out the video version because we do share a graphic and discuss a graphic of a particular model that they use with their clients that you may find interesting. I'm going to put a link in the show notes to a PDF that describes that graphic so you can check that out. During the conversation, we allude to sharing a spreadsheet. I'm going to hold off on sharing that spreadsheet because it does have some of their secret sauce in it, but you will get the PDF in the show notes so that you can take a look at that. And I'll put links in the show notes to Craig's website and Noli's website so that you can check them out and contact them if you would like to do that. I consider Craig and Noli good friends of mine. We have worked together over the years helping construction companies. I think you will find this interview extremely helpful, extremely insightful. Feel free to share it with other people who may be facing challenges in terms of putting together a good exit plan, because there are insights here, regardless of what model that you use for that exit planning, that you will find tremendously useful. Thank you again for listening to Construction Genius, and enjoy my interview with Craig and Noli. This is Eric Anderton, and you're listening to Construction Genius, a leadership masterclass. Thomas Edison said that genius is 1% inspiration and 99% perspiration. If you're a construction leader, you know all about the perspiration, and this show is all about the 1% inspiration that you can add to your hard work to help you to improve your leadership. Craig, Noli, welcome to Construction Genius.
Thank you for having us. You bet.
I tell you, I've been looking forward to this conversation for quite a while. And the reason is I know many construction company owners, they spend 20, 30, 40 years of their lives building a killer construction company. And they want to be able to create a legacy for themselves, perhaps pass the company on or benefit financially from selling the company. But they really struggle with this whole idea of succession planning and setting up their company for passing it on to the next generation. Why do you think construction company owners struggle with that so much?
I think partially they don't give it a lot of thought. It's a tough business. All businesses are difficult, but You're consumed with the everyday proposition of running the business, of building the business, finding people. And you get so consumed with that, and time passes so quickly. One day you wake up and you're in your mid-50s or older, and you just haven't given it the consideration just because it's not pressing, nobody's making you do it, and you just have so many other things on your plate.
And I think there's actually a step further than that too, Eric. And in my mind, there's a direct correlation between business owners who can be really good contractors, but are also really good business owners, and the mentorship that they put into their people. There's a correlation there between the folks that are good mentors being able to transition more smoothly into a second generation of ownership internal.
Okay. So let's pursue that a little bit. When you think of a good mentor in your observation of construction company owners, and you guys have worked with contractors for decades, what is in your mind the definition of a good mentor?
Yeah, it's a great question. We talk about this internally all the time. I think a good mentor is somebody who's going to teach you, obviously, how to do the job, but the whys behind how you do the job, the whys behind how to take care of people, how to take care of people in general. I think they're going to bring you into the fold in terms of running the business, understanding how that simple one project that you're working on impacts the entirety of the business, helping you to think globally, and taking an interest in you personally, right? I think every good mentor relationship has a personal aspect to it as well.
I think a good mentor and a qualification to be able to be the type of a G1 owner that can successfully succeed ownership to a G2 group is going to be somebody who doesn't micromanage people. In fact, when we step into organizations who want to succeed ownership and we see that they are a micromanager, they may not be a good candidate because they likely will not have given people room to grow and to experience all of the various aspects of the business they need to experience. It seems like many owners are willing to let key employees do certain things, but there's some sacred cows: dealing with an irate customer, dealing with my bank, dealing with my bonding companies, as a few examples, but some aspects that these are things that only I can do. And if they have those sacred cows and don't let these people come in and be a part of those meetings and see that aspect of the business, that G1 owner will never be comfortable in succeeding ownership because those things will scare them to death. They will keep them awake at night. That those people will not have the ability to negotiate through those challenges that come along.
So let me ask you that. If I'm the construction company owner, perhaps in my mind, I'm saying, well, that client's my client. And, if this guy who works for me leaves the business, that's fine. But if this client leaves me, then that's going to have a massive impact on my business. This banking relationship, this bonding relationship, this surety relationship, these are all things that I've developed. And perhaps I don't trust the people in my company to take care of those relationships. How have you seen construction company owners deal with those kinds of fears, frankly, that limit them in their ability to develop the next generation?
Yeah, I think it's an interesting little dilemma, Eric. In my mind, what you have to do is treat people so that they won't leave. And it's this dichotomy where if I treat them the way they want to be treated, they may leave. But you got to treat them well enough so that they don't leave. And we've implemented all sorts of different mechanisms, from a golden handcuffs perspective, whether that's deferred compensation or succession planning, both work really well. But I want to touch on something, though, that you kind of mentioned.
Sure.
Particularly for public works contractors, that surety relationship is critical. And the strength of the balance sheet becomes somewhat of a limiting factor to an employee going off and competing with you right out of the gate. You're not going to be able to go out and build a brand new K-12, school as a new general contractor. perhaps you start with some TI work and whatnot, but there are some hurdles there that you'd have to clear.
Yeah, absolutely. So what is the starting point in your mind as you begin to discuss succession planning with your clients? What is the starting point that you like to direct your clients towards?
I think both Noli and I, when we sit down with clients, we typically, and we usually have a pretty good understanding of this, Eric, but we typically let's talk about the people. Let's put their names down. Let's put their ages down. Are these people fiscally and financially responsible? Do these people get along with each other? What are their roles in the business? Does this group of people, however many it might be, do they cover the main areas that need to be covered? Do they cover estimating, project management, field supervision? Is there a leader among the group? Somebody who has business acumen, somebody who can be responsible for hiring and training and just the administrative parts of the business. So we want to make sure that there's at least a framework here of individuals that can even create an environment for doing a succession plan.
Yeah, that's excellent. I think it's critical to understand that the owner is looking at his people in terms of those key aspects of the construction business, the bidding, the building, the planning, and the leading of the company. That's fundamental. So what if I'm a construction company owner? I'm looking within my company and maybe I see one or two of those aspects, but I'm missing a couple of those. What should I do in that circumstance?
What we've done in the past, Eric, is we've put out searches to try to find a piece that you're missing. We work with a bridge builder who had to go out and find key employees to transition the business to, and that worked out really well.
That's terrific.
Yeah. I would say we also, to be practical about it, we'll say if you don't have all of the key components now, getting people is difficult. We all know that. They're going to have to adjust their horizon a little bit. They're going to have to be practical and say, well, if I'm missing a key component or two, first of all, they need to make that a priority. And two, they need to realize it's going to take some time. So they're going to have to not shelve it, but move at a slower pace, because people are the key to this, to any plan.
Internal succession.
Okay, so let's talk about that idea of horizon. So hopefully you're not waking up at 55, 58 saying, I want to be done by 60, and you've got to cram this all in. What kind of horizon are you encouraging the contractors that you work with in terms of the timeline they need to put this thing together?
Yeah, so we've developed a mechanism for transitioning ownership, Eric, and we typically model that plan out to be about 7 years, 7 or 8 years, which I think is a good lead time to get these folks up and running completely. Now, the whole point of developing a motivational model is that these second generation, we'll call them G2 folks, are incentivized to kick butt, make as much money as fast as you can so that you can get G1 bought out. And a well-structured plan certainly does that.
Okay. Now, 7 to 8 years, that sounds relatively short. Should they be thinking even earlier in the process in terms of identifying the folks who may want to be able to take over from an internal perspective?
I think that harkens back to the discussion we had a little earlier, and that is you want to start thinking about, even as a young owner of a construction business, how am I going to get out of this business? By the way, whether you do a third-party sale, an internal sale, however you exit your business, developing people, mentoring people, preparing them, not being a micromanager, creating training programs within your organization. All of these things are going to create an environment for you, whether it's 10, 15, or 20 years later, you're going to find yourself, you're not only going to be it's not going to be a better succession plan, you'll be a better company today. And better companies transition better, whether it's a third-party sale or they transition to key employees.
Hey, Eric, let me throw a question at you, because I know I've heard you speak, obviously a dozen times, and I know you embrace the younger generations. It's almost a necessity now to have a culture of mentorship for some of the younger generations. Would you agree with that? It's almost baked into the company, or it has to be.
Yeah, I think the younger generations are very much looking for that. They're finding a lot of their purpose and meaning in work. And I think that if you're going to have a long-term successful company, you have to be committed to that idea of mentorship. It's a tremendous struggle, because in construction, when I'm the owner, I am putting so much on the line. And so my tendency to micromanage may increase exponentially, just because there is so much risk. And if this project goes south, it could have a tremendous negative impact upon not only my net worth, but perhaps other aspects of my life. And so what you're saying about this idea of micromanagement, I do see that as a struggle with a lot of construction company owners, even though they know that they need to develop those folks and mentor those folks.
That's a good point.
I'd like to explore a little bit about this mechanism, because, in terms of the passing on of the business, whether it's an outside sale or internal, there's many ways to skin the cat. Can you describe 2 or 3 mechanisms that you have seen to work for construction companies over the years?
Certainly. We've all heard of a stock transaction, selling stock from one owner to the other. We're all familiar with ESOPs.
Yep.
And maybe some of the struggles that come with an ESOP in a construction company in terms of indemnification and whatnot. But we at BFBA have utilized what we refer to as an LLC model to transition ownership. And it's pretty slick. The whole concept of which, Eric, is that you want to transition the business to the best you can without leveraging the balance sheet or weakening the strength of the company financially, whether that's with debt or pulling capital out or whatever the case might be. And so this model allows you a mechanism to do that.
Okay, well, let's explore that a little bit then, because I think everyone, like you said, is familiar with this idea of ESOP, or maybe some guy just swoops on in and he wants to grow he wants to purchase your business because he wants your customers or something like that. But in terms of an internal transition, you guys have used this LLC model. Think of me as someone who has never heard of this before. What are some highlights of it that might be able to help me to begin to grasp it and to think about how I should look at it?
Sure. So one aspect, Eric, is when you're talking about transitioning or selling a business, you're not just talking to the person who's running it day to day. That person oftentimes is married to somebody, has a significant other, and that person gets very much involved in this process. And even though they may not be there on day to day, they can understand concepts like, well, we've worked many years and we've built up all of this equity. It's been through our risk and our efforts. And we've made these sacrifices. So what oftentimes resonates with business owners, and very often with their spouses, is that in this LLC model, we're not sharing any of the past. It's all going to happen through future profits. So if I give somebody stock, well, typically these people don't have stock, so I've got to give them a large bonus. They've got to pay taxes on that. Then they buy stock. Now I've given them, I've hit my equity to bring this person in. And theoretically, if the market changed at that point, or if that person wasn't who I always thought they would be, or if their life changes and they're not able to deliver what they wanted to and what I thought they could, then I've in essence given up some of the past to bring them in. Whereas in the LLC model, it's all through future earnings. I give you a profits interest today. I give you a bucket that is empty, but it's got the potential to earn future profits rapidly. And you can fill that bucket up as I take money out. That balance sheet is transitioning to you. So that oftentimes resonates with an owner because, hey, if we go 4 or 5 years and nothing's happened, then I've given up nothing, you've got nothing. But if you're successful, then this happens very quickly. And it's very motivational.
And Eric, it's actually good that you have both of us here because Craig represents G1, I represent G2 in a lot of our meetings and discussions. And our model's not too dissimilar from this.
Okay.
So if you think about a stock transaction, there are certain elements to it that make it super prohibitive to transition ownership quickly. In fact, we get involved in conversations with second generation owners who are saying, I've been in plan 5, 7, 10 years and I still only own 8, 12%. How? Because once again, the strength of the balance sheet becomes a limiting factor. How do I get them enough capital to buy into the existing equity? That's what Craig was touching on. It's very difficult. As a second generation owner, I look at it and I say, how do I do this without putting a bunch of debt on my personal balance sheet? Right? Which also makes it trickier to transition your personal guarantee relationship with your surety and bank, because the faster we can get that surety and bank to stop looking at Craig and start looking at Noli, the faster this transition is going to happen as well. And so ultimately, we're not transitioning stock any longer. We're not going to be limited with having to make equal distributions proportionate between each other. In an LLC, they're super flexible. You can go in, like Craig mentioned, and grant me a 30, 40% profit sharing interest right away. From the IRS's perspective, the company was worth roughly net book value. Craig kept net book value in his own bucket. I start with an empty bucket, but over time, I build my bucket with sweat equity. Craig takes all the distributions out, and over time, the equity swaps, from G1 to G2.
So for people watching on the video here, I've shared a screen of just an outline of the model here. Can you guys see that?
Yes, we can.
Okay. Now this is the model that you guys have put together. Do you want to just walk us through this? Where would you start someone if you're walking them through this?
Yeah, sure. By explaining the differences between a corporation and a limited liability company. Prior to 2013, you couldn't put a contractor's license into an LLC.
In California.
In the state of California. Yeah, my apologies. And so what we would do is create an LLC. Right out of the gate, we would create it as a single member LLC, wholly owned by the S corporation. I'm assuming it's an S corporation. And we would take the entirety of the balance sheet of that S corporation and we would drop it into the LLC in a tax-free transaction. That LLC now becomes the operating entity. And there's some nuances there, Eric, that are, I'm making it sound simple, but you've got to sign contracts and get a contractor's license in it and whatnot. Once you have that LLC and you're up and operating, you can take those key employees and grant them future profit sharing interests in that entity.
Which is here on the circles on the right.
That's correct, yes. And you can see there in that example, it's 20% for two folks and 10% for the other. So we've now transferred effectively 50% of the future profits of the company to 3 key employees. Now they begin building their equity with income, and then as does the S Corp if we're 50-50. But all of the free cash flow, all of the distributions can go out to the S Corp to bring it down. That is a super slick way to use those future profits to buy the company out.
The S corporation continues to exist. It's just simply now a member in the LLC that has a profits interest. Its goal is to bring its profits interest down to 0 eventually. And as it gives up profits interest, it would give it to one of these individuals off to the right in the balloon circles there, or some other individual that the company may not now have, that collectively the group feels they need. And so that profits interest by the corporation is given up over time.
And you say over time, Craig, I think it's a function of, and there is no set number, it's very flexible. How old is the exiting owner? How much do they want out of the business? How long do they want to hang out? So when we start these conversations, Eric, a question that's often brought up is, when do I actually own the company? And Craig always asks, well, what does ownership mean? And for us, it means largely control of the organization. And so
hold on, let me interrupt you. That's the second generation or G2 asking, so yes. When do I own the business?
Yes, exactly. And so we typically, when we build these operating agreements for the LLC, we typically have safeguards for both sides. And there's 2 triggering events that would transition ownership to the younger generation. Or control. Yeah, that's what, yeah. The first of which is, Craig, in my example, no longer signs any personal indemnification.
Right.
On bank, on surety, all of his personal risk is off the table. The second of which is the capital accounts, once I own a majority, become proportionate. And so the game there that you would play if you're Craig is, as soon as I start to catch up and get proportionate, I'll give him another 10 or 20%. So he's got more to catch up. All the way through that 7-year period, the way we model it, until Craig has no longer any future profit sharing interest, and I've paid him all of his capital. So basically those two triggering events are A, no more personal indemnification, and B, I've gotten all of my cash out of this thing.
So let me address that idea of the personal indemnification. How much of that specifically is an obstacle to a transition? Because it's one thing to want to be an owner. It's another thing to actually put your house on the line, have that conversation with your spouse, significant other. So can you please address that?
I think so there's a couple of answers here, Eric. First of all, getting creditors to get their head around what's going to happen to this balance sheet in the future. When they understand this model, they love it because they realize that there'll be no degradation of the balance sheet at all. Money's not going to come out for transition. It's going to be out of future profits. That the equity of the company, its working capital, its liquidity is going to remain the same or even get better into the future. So, and if you go in with a good balance sheet, and I would never do a succession plan that didn't have a strong balance sheet to begin with. If we didn't, we would begin there.
Okay, hold on. Let me interrupt you. Define for me what you mean by a strong balance sheet. What in your mind equals a strong balance sheet?
So a balance sheet that is capable of weathering a storm. If there's a bad economy, if a customer can't pay me for a while, I get into some litigation or whatever, my balance sheet is strong enough. I have enough equity and liquidity that I can make it through a difficult time. I'm not just up to my nose, and I'm not overly leveraged. I mean, there's covenants we could talk about here, Eric. That's for a different conversation. Sure. But yeah, a balance sheet that a creditor, a surety company, and a bank would look at and say, I'm comfortable with this balance sheet.
Okay.
Given the size of this business.
I do think that's an important thing to bring up, though, because we can talk all day about mentoring people and developing people. But if your business is fundamentally unsound, it's going to be difficult to transition it.
Not only that, Eric, absolutely, it's going to be difficult to transition. But the value of the business is probably not what you want it to be. And you're wanting out for this big number, right?
Right.
If I'm a key employee in a company that struggles to pay its creditors timely, I'm likely not going to want to be a part of the ownership going forward.
Yeah, absolutely. Okay, so looking at this model, and what would you say is the main reason it won't work? We've talked about the balance sheet strength. Why won't it work?
You know, it's funny. We go back and forth on this all the time, Eric. We were introduced to a local contractor and introduced this model to them. And they had an old friend CPA vet this model for 3 days trying to poke holes in it. And he came back and said, it's the best model we can find. I would say this, in the situations where a client has opted not to use this, it's been because of ease, okay? There's an administrative task associated with setting up a new entity, associated with a new contractor's license. Candidly, if you're doing some CM at risk work or some lease-back type work, your experience factor in your license is very important. And we've got to there's ways around it. We can make it work. But you've got to consider those types of things. Transitioning all of your rolling stock, all of your equipment. If you do transition the equipment, sometimes we don't. All of these things are an administrative burden, primarily on your controller CFO type person. So that's been the reason that folks who have been introduced to the model say, I'd rather just sell stock.
Right.
So recently, Eric, we were approached by an engineering client of ours of many years, General Engineering, and they wanted to talk about succession. And we went over all of the different models and ways to do it. This model resonated with them. We knew and we said, your internal accounting is not strong enough to do this. You don't have the right controller in your organization, the right horsepower to see this all the way through. So he began immediately to find that person. He found that person. We began to, make sure that she was everything we thought she was going to be. And then we began the process. They're now through it, done the transaction, and she's done a yeoman's job. Had they began the process with the person they had before, it wouldn't have been able to work.
So that's interesting, because it's not only identifying the future owners in terms of who can bid the work, plan the work, build the work, sell the work, and run the business, but you need that administrator to get through a process like this effectively.
And I take it a step further and say they're just good to have in your business.
Absolutely. Yeah. But they're not, many times they're not there in a contractor's.
Yep. Right. That's right. So there's easier ways to do this. If you don't have a strong accounting, you don't have strong administration, and Noli's point is a good one. There are easier ways to do it. And if people don't want to upgrade their administrative horsepower and accounting horsepower, they may just opt for a simpler, even though it's not the best way, but a simpler way.
And let me just throw one of those out, Eric, that I've seen pretty consistently. I'd say pretty consistently in the handful of times that they don't want to use this model. Oftentimes, the restrictive factor in buying stock is that net book value, the total equity, the value of the company.
Yeah.
So we've had situations where we've done large distributions out to the G1 owner to drive the equity balance down and have them put it back into the company as subordinated debt, subordinated to the surety and to the bank. That brings the purchase price of each share of stock down, and that transition can work. But you are converting equity for debt, and it's not exactly the same.
Okay. Now, as we look at this model, I know you guys have used the analogy of an arranged marriage.
Yeah. Yes.
Tell me about why is it important for the parties involved to think in those terms?
Yeah. So when Craig founded BFBA, he got to choose his partners, and there were four of them in total, 3 partners plus Craig. Craig transitioning to me is picking 2 or 3 of us to transition the business to.
Right.
And the 3 of us have to be on board with each other. It's somewhat of an arranged marriage in that regard.
Okay.
And so, and as you know, Eric, and as Craig and I know, and every business owner knows, that in tough times, those relationships get to be a little stressed. And if they do, how is everyone going to react? We've seen situations where partnerships are disbanded because of stressful situations.
Right.
Where it typically falls apart, Eric, is does everybody have the same work ethic? Does everybody have the same tolerance for risk?
Yeah.
And is everybody in the group? Are there certain people who just don't want to communicate? They're just not cooperative in their approach. If a business is run and owned by one person, maybe 2 people, and now it's been transitioned to 4 or 5, those 4 or 5 people need to communicate. They need to get along. There needs to be mutual respect. And in every case, these people need to have integrity. And that's where we always begin, is make sure that if there's anything questionable about somebody's integrity, regardless of their abilities, they probably should not be a part of your plan.
You know what? Let me jump in here, Craig. You just touched on something, and we keep talking about 3 owners, 4 owners, 2 owners, whatever the case might be. I personally believe, Eric, that there is a right number of owners.
Okay. What is that?
Well, it depends on the size of the organization. But what you don't want to have is a succession plan where none of the individuals, none of the G2 folks feel like owners. And that feeling of ownership can differ from the percentage of ownership. I want to make that clear delineation between the 2.
Okay, so let me ask you then, in your experience, at what percentage point does someone feel like an owner?
I mean, Craig, my take is always 10%. At 10%, and mind you, Eric, oftentimes at 10%, you're signing personal indemnification for the bank and the surety. And not only that, your wife is signing, or your spouse, your husband is signing personal indemnification. And that becomes, that can become a sticking point. But prior to getting to 10%, I've heard it before from succession plans that aren't working. You can somewhat feel like, a glorified employee.
Right. I know in my experience working with construction companies, one of the big challenges of partnership is final decision making. Who's going to make the final decision? Now, when you're setting up a model like this, the LLC model with ownership distributed among multiple individuals, if you've identified someone who's going to be, let's say, the president, CEO, how much ownership should that person have so that they feel secure and the other people feel secure in them making the final decision from an ownership perspective?
That's an outstanding question, Eric, and one that gets raised often. Many times a person may have 2, 3, 4 people that they feel like they're all very critical to the business. I just want to split it up evenly among them. That's the simple thing. That's the simple conversation to have. But we typically say that's probably not going to be the best thing to do. Keep in mind, when you begin this process, you're going to give up a part of the profits interest, not all of it. So over time, you're going to give up more. But there needs to be rules of governance. You can't run a company by committee. There needs to be a president. And that president needs to be groomed by this person, G1, prior to even going into this process. So they know who's going to be the person who's going to be the leader of the company going forward. And then, yes, Eric, I think Noli would agree with me, in the succession plans we've been a part of, somebody needs to emerge as the leader of the business, somebody that has the mutual respect of everybody else in the room. And that person, I think, needs to have more ownership than anybody else. And I think that over time in successful plans, it just evolves that way because it needs to.
And Eric, let me add on to that. This notion of control is critical. And I touched on it earlier in this LLC model, but I'm gonna make it even more blatant now. When you're doing a stock transaction, once you give up 51%, you're at the mercy of the people that own 51%. In this LLC model, you're going to control your organization until those 2 triggering events are met. You could own 10% and still control it. That's critical.
Oh, okay, and repeat just for the audience's sake, those 2 triggering events.
Yeah, so the 2 triggering events, once again, are G1 is no longer signing personal guarantees.
Perfect.
And you have received all of your capital out of the business.
And when you say all of your capital, that's based on the valuation that you made of the business
early on
at the beginning of the process.
Absolutely.
Okay.
My second point in saying that is, as a G2 owner, I always appreciated. This is a comment for the G1 owners, that Craig and the founding partners of our organization have always said to us, it's almost like raising a child and just keeping them on the street. They're going to stray on this street, but you got to keep them on the street. And they've always said to us, hey, we're going to be gone, you guys. You need to make this decision. They would never let us leave the street, but they would tell us, hey, it's your organization. You're the future. Make this decision. And I will tell you that that's the feeling of ownership that I'm alluding to.
But that requires then a tremendous amount of discipline on the part of the G1 people when if they feel that you may be still on the street, but perhaps you're on the right side of the street instead of the left side. And G1 would say, in this situation, I'd be on the left side. And that's where that micromanagement can start to happen again.
Absolutely. But as fathers, we all know that sometimes you need to let them be on the left side to figure that piece out.
Yeah, that's interesting. So let me ask you, just something popped into my head, and maybe out of my ignorance, I misunderstand this. Let's say my business was valued at, let's say, $8 million when we begin the process.
Sure.
And then my future owners start kicking some serious butt, and I can see that my business is going to be valued at way more at the end of this process. And I start to get itchy feet saying, hold on a second, I still own the business. Can we renegotiate here? Does that ever happen?
Yes, it happens. But if it happens, Eric, it's all going to fall apart. If a G1 owner or owners become greedy, and that's one of the reasons why succession doesn't work in a lot of businesses. G1 owners get too greedy, whether it's at the beginning of the process and valuing the business to begin with, or at anywhere along the line. If they get too greedy, this will fall apart in every case.
Hey, Eric, let me talk about the mechanism real quickly as to how that can happen, though, in this LLC model. The only thing that's promised to G2 is the initial tranche of ownership that we transfer. So the spigot, in terms of how much G1 gets in this buyout, is simply how long do I maintain my 50% share? And so if we're kicking butt and making tons of money, I can simply hold off for a couple of more years. Now, it's going to ruffle some feathers, to Craig's point, but now I can share in more of those profits and transition 2 or 3 years later, thereby obtaining another $2 million in my sales price.
The way I can sell that, Eric, is I can say as a G1 owner, I'm willing to stay on as an indemnitor longer. I have a deeper pocket than G2 has. You're using all of your money to buy me out. So in order for me to stay in longer, I'm going to want to keep some of the profits interest longer, but it will allow us to go after bigger jobs because I'm going to stay on longer as an indemnitor.
Okay.
Usually that will resonate.
So it's so interesting, though, because as we're describing this process, there's a tremendous amount of work that's going in here. And also, it is really dependent upon the character of all of the parties involved, both G1 and G2.
Absolutely. Could not state it any better.
And Eric, yeah, I would add that if there were character questions to begin with, it's a lot easier not to get married than to get divorced.
There's a bit of wisdom right there. So I just wanted to have a quick summary here. If I'm the president of my company and I begin to think of succession planning, I have to think about, and I'm thinking about an internal succession specifically, I have to think about developing my folks into those senior roles in the key parts of the company. I have to think about the strength of the team working together of the second generation. I have to think about the potential mechanisms to go through the transition, one of which you've described here with the LLC model. And then with that in mind, I have to commit to the administrative aspect of it as well. So there's a lot that I really have to be working on. How do I, as a G1 owner, find time to do any of this?
Well, that's interesting. And I will not only say, not only is it hard to find time, Eric, but most people, when they think about a succession plan, they don't even know who to talk to. Do I talk to my CPA? Do I talk to my attorney? Do I talk to my financial planner? Do I talk to some boutique firm or who does succession planning? And the fact of the matter is, it oftentimes takes a team of people. And anytime you're going to begin this process, you're going to want to deal with somebody who is familiar with all of the aspects. When we do this, we bring a team in. We bring in attorneys who have had lots of experience in succession planning, and particularly if we use the LLC model, experience with partnership accounting and partnership transition. And to the extent that there may be family issues or the soft side of it, dealing with people, there are organizations out there similar to you, Eric, where you can come in and help people communicate and kind of get all the sacred cows on the table. Even spouses, because oftentimes these things become an impediment. So there's a lot of movable parts, and typically it's not just one organization that can see an organization through, but it's a team of people. And at BFBA, we've done so much of this, we recognize what we do really well and where we need help. And we can usually identify those things early and then try to bring in the right people to help facilitate the process.
Hey, Eric, in all of those things that you touched on, in my estimation, the hardest part is the mentorship. And you got to be doing that anyways these days.
Yep.
Right. And so in my mind, the administrative tasks, the burden, that's where the team of people comes in. I think as a G1 owner, you are largely responsible for creating that second level of people.
Okay. Let's say I'm listening to this podcast. I've got this sort of mixture of hope because perhaps there's some ideas I'm getting, but then also maybe, dude, I've tried this and it hasn't worked so far and I'm getting so frustrated. What would you recommend to a construction company owner to sort of maybe clear the decks a little bit and have a fresh perspective on succession if I've tried it and it hasn't worked at this point?
Well, the bottom line is you got to keep trying. Because we have certainly sat down with people who have said that, and they're a little cynical because I've been burned a couple of times before. Why is this going to be different? But we need to continue to try.
Why? Let's touch on why. What happens if you just give up and you want to shut your doors, Craig? What in your experience has happened?
Well, what happens is you start ending up with limited options because you're going to continue to get older. Yep. Desire to do the business is going to fade. Health is going to fade. And if you don't do something and if you don't remain proactive and carve out time and energy to continue in this process, you will find yourself in a place one day where you don't want to be.
Yeah, and largely, and what I was getting at there, Craig touched on it, is this. Nobody wants to be a part of an organization that lacks a future, Eric. And so if that succession plan isn't there, and your plan is to just shut the doors, take my money and go, then your people are going to sense that. And they're going to leave. And when they leave and you still have projects in progress, it's going to hurt.
Yep. So it's interesting.
You're just not going to attract top talent. When these succession plans begin, Eric, we've noticed that key employees become the biggest ambassadors for the business. They're out recruiting people from other organizations and saying, look, are your owners doing this? This is what we're doing in our organization. And they know where they need help, and they're able to recruit people from other best-in-class organizations as well, who may not have a plan in place for succession.
Hey, Eric, real quick, while you're right before you ask a question, I think we need to touch on the fact that in today's market, if you are a specialty trade subcontractor, we are seeing private equity money in the marketplace right now.
Right.
Buying up. It's almost these roll-up type companies that are buying up, third parties buying up construction companies.
Particularly specific kind of construction companies like mechanical contractors, for instance.
Yes. Well, contractors who have a real niche, who have an organization where it typically takes a college education at some level to run the business. Yeah, those organizations are going to be more of a candidate.
I'm going to put a link in the show notes to this LLC model that we've been describing. Again, if you haven't been able to see the video version of this, you should check it out because we've shared that. But you can also download that LLC model, and it also includes a spreadsheet so you can take a look at how the numbers would work over time. And I just want to thank you guys for generously sharing that. As we are wrapping up our conversation here, let's begin to think about some action items. Time is either your friend or your enemy, right? If you've wasted your time or if you haven't been diligent in going through this process, time can be your enemy. Time is your friend if you're thinking ahead of time, 15, 20 years and doing the work. What are 3 or 4 action items that you would recommend to a construction company owner to immediately take in the next 30, 60, 90 days to get this process moving?
One thing I would say is that any kind of a succession plan, however you do it, whether it be an ESOP, the LLC model, a stock purchase plan, stock options, however you do it, it takes some time. But if you've got people that you've been talking to for a long time about succession and they're eager, you may want to put some kind of a mechanism in place that shows them that you're really interested in the process. We like to use non-qualified deferred compensation, where you carve out a piece of the income and you carve out a group of key people who likely will be part of a succession plan, and you put them into a non-qualified deferred comp plan where they can start building up some skin in the game, so real equity. And now they know that you've taken a real step towards the succession. You can do that. We've had companies do this, Eric, for 2-3 years before we actually got the plan in place. This is typically a much bigger company with lots of movable parts where it was just going to take time to do it. So
you want to touch on the vesting?
Yeah, so the way a non-qualified deferred comp plan would work is there would be vesting where you would maybe 3-year vest, and we found that to be pretty good. So in year 1, you get nothing. Year 2, you get nothing. Year 3, you get year 1. So at any time you leave as a key employee in this and participant in this plan, you're going to be walking away from 2 years. Now, once the plan is in place, then people can become fully vested and they get their payout, and then that can go into their capital account, into the LLC model. And so now they have real skin in the game. So in essence, you began the process earlier in terms of getting them capital and skin in the game, but you've let time pass where the owner is trying to vet some of these other things that we've been talking about.
Okay, so right there, dude, to me, that's a key consideration in terms of making a plan like this work. because that whole idea of getting skin in the game, but then also giving them a means of building up some money. Because frankly, so many of these G2 folks, they may want to buy in, but they don't see it. They don't have the cash to begin with. So that's a key aspect right there.
Absolutely. Skin in the game is critical.
So getting that compensation plan together, what's another action item or two that I might want to take to begin this process?
Maybe even a step before that, identifying your successors.
Okay.
Craig touched on it early on in the conversation.
Yep.
I think you've got to do a self-assessment of your organization and figure out who those individuals are, and or if you even have all the pieces necessary. Sometimes that can be an estimator, a project manager, and a superintendent. Sometimes you may want to include a CFO in that mix.
Yep.
Right. And so assessing that whole situation is pretty critical.
Excellent. Excellent. It would seem to me also, and this is an obvious thing to say, but having that outside group of trusted advisors who are able to bring you clarity in the midst of these difficult situations and difficult thinking processes, and people that you can trust to give you good advice. Developing those relationships seems to be critical.
I would not only, I agree with that, Eric, and I would go a step further, that when it comes to business transition, ownership transition, you just need to deal with people who have had a lot of experience. You don't want it to be their first rodeo.
Yep.
There are so many pitfalls involved in this process that can be avoided through experience. So you want to have a professional who has been involved in this process many, many times, who has worked with somebody like you. You don't know what you don't know. And oftentimes you hit your head against the wall because you're just getting bad advice. You're getting simplistic advice that it just rolls off some professional's tongue because other people do it. You want to be dealing with somebody who have been there, seen it, done it. It's a difficult process enough. You need to have a group of people who understand how to navigate through the process.
Excellent. So with that in mind, as we're wrapping up, if someone would want to get hold of you and just reach out to you and maybe get some more information or learn more about your company, how can they do that?
Yeah, well, certainly on the website, BFBA.com. Craig and I each have a page up there, and we've got an entire section dedicated to succession planning. Or you can just give us a holler. I don't know if you're going to put up a phone number or anything, Eric. I can just spout it off.
Yeah, I mean, I can put I put all the contact information in the show notes and links to your website. Absolutely happy to do that. That would be terrific.
Perfect. Yeah, but reach out, and we will always be confidential in everything that you share with us. But we're more than willing to sign waivers, non-disclosure agreements.
And just for the record, because I know we've spent a lot of time going through this LLC model. This is a model that you're actually using in your own company for the transition.
Well, professional service companies can't be an LLC, but they can be an LLP.
Okay.
And they're similar. So yes, it works about the same way.
Very similar.
Okay, great. So in other words, you are eating your own dog food. You're not just throwing something out there that you think might work.
Absolutely.
Absolutely. This guy right here is the sucker, and this guy right here is the one that's going to be riding off into the sunset.
Yeah, I know you guys, and I know that's not quite how your relationship works. Awesome. Well, Craig Noli, you've been very generous with your time. I really appreciate the insights that you shared here today, and I'm going to make sure that we have the link to this model in the show notes, the link to your website if people want to get in touch with you. And again, I really appreciate your generosity here today.
Eric, thank you. Yeah, absolutely.
Today's episode was brought to you by the Construction Conclave. If you as a construction leader would like to develop your skills and get involved in a community of like-minded construction professionals who are focused on building healthy teams, profitable projects, and long-term successful businesses, then the Construction Conclave is for you. It's a private invitation-only group of construction leaders that are focused on developing their leadership skills. We do training every single month online that looks at how to become a better leader in a very practical, straightforward way. We also have other events that build community and camaraderie so that you can associate with others who are interested in developing their skills as leaders. If you'd like more information and to see if you qualify for participating in the conclave, feel free to reach out to me, eric@ericanderton.com. Thank you for listening to this episode of Construction Genius. Hope you found that 1% of inspiration to help you in the next few days. If you like the show, please give us a 5-star review on iTunes, share it with other construction leaders who you think would benefit, and thanks again for listening.